Hello, everybody. I'm so glad to once again welcome you here. I'm Amrita Gandikota. I'm the India representative for GINSEP, and I welcome you all again for the Investor Day. We now have Mr. Vikas Kutiala from the Indian Angel Network. He's an angel investor at the Indian Angel Network, and he would be sharing with us through a workshop the art of pitching to investors. I would once again like to thank the Indian Angel Network here because they've been the partners for the day. And as you know, we have this whole program scheduled to 5 different days. And today we are focusing specifically on investors and investments and promoting investments between Germany and India. And at this point, we had Mrs. Padmaja Ruparel speaking as the keynote speaker this morning, and we have had a few other German funds pitching. We also had an interesting round of startup stories where a couple of startups and an investor shared their perspectives and experiences working with different kinds of investors, their hiccups, and so on. So now we are coming to almost to the finale of the whole week, and I welcome Mr. Vikas Kutiala here to speak about the art of pitching to investors. So I give the floor to Vikas. Thank you so much.
Thank you, Amrita. Welcome, everyone. This is Vikas Kutiala, and I'm going to speak on the art of pitching to investors with a focus on startups. So the first thing I want to say is, to the founders and to the investors alike, that whether you are an investor or a founder, because you have to have shared goals and shared vision of what you are collectively trying to achieve, then the art of pitching is actually a topic which is equally important for both of them to get a sense of. And there is always a cultural slant. There are always some market imperatives. There are always other such business parameters that are specific and unique to a country and a culture, and which is important to take care of when one is either pitching in that jurisdiction or if one is looking for startups in the jurisdiction. So therefore, the context that I have is from an Indian perspective, but because startups today are started with the ambition that if you really think that you want to be big, you have to aim from the very first day to be globally competitive and capable of competing against global startups and ventures. So therefore, overall, the principles that I will outline in my presentation would be quite unique and relevant in a cross-cultural sense. So I will start. It's a presentation I prepared last month when I was a guest at the AWS on the same topic. So it makes my life easy to talk to you about on this presentation. So every founder must first understand that a pitch to the investor is like a B2B pitch, as though you are making a pitch to sell the story of your business. So usually, very often, the story is that the pitch is made by people who are maybe not adept at business development, that people who are techies, there are people who are domain experts, maybe from healthcare or from any other field, and they may not have the skills that are required for them to pitch successfully to investors. But my first advice to them is that please learn very quickly, because the idea that you may have, the traction that you may have, the opportunity that you so passionately believe in will only be accepted to the prospective investors if you understand how a business pitch is made. And this, in fact, could be the most important pitch that you would make when you start the journey of your business. So therefore, first and foremost, please make sure that you are able to articulate your business pitch as a business story to prospective investors. Something that people don't normally pay much attention to because they're so consumed about what they think. And very often, people tell you that, oh, it's about storytelling, it's about engaging. All of that is true, but those are just metaphors. But the business definition of storytelling in the context of trying to raise investment funds is that you have to try your best in tangibilizing the future success of your venture in a credible way in the context of today. Because what you are selling is not something which is a story, which is exciting, engaging. You are basically telling the prospective investors that this is real, this is believable, it is based on a set of assumptions and criteria that it will succeed in the future from where we are today. And when I say tangibilizing, I'll give more texture to the term tangibilizing as I go through the presentation. But it's important for you to be able to define to the point that they can feel it and they can understand it, they can literally almost see it. The first and foremost and important thing that an investor will look for in India, and I'm sure this is true about most markets, is a clear articulation of the prospective consumer need that you're targeting. And if there is a need, does that translate into a market gap? And if that is the market gap, then what is the overall market opportunity map within which you think you've identified a need? Because that will demonstrate that you have kind of understood the whole context within which you're trying to create a success. And there are products and services in the neighborhood before and after, but the bullseye target that you have identified is somehow still an opportunity which has not been addressed. And this must be very clearly and very sharply articulated with the convincing story and convincing data and convincing, should I say, parameters and metrics that there is scale in it and the unit economics makes sense. These are very important in the early on to engage the attention of a prospective investor. So the founder must have a very sharply defined market need of the customer in a market gap, in the larger opportunity and the scale and the unit economics. That is very important. The pitch must be customized to what the investors are looking for, using the right metrics and not just metaphors to smartly position. Because remember, it's not only convincing the investor that how real is the possibility of you creating a success by using all the things I said before, the market map, the market opportunity, the gap, the need, and maybe doing it in an engaging manner, using metaphors, using data. But you have to get into the mind of the investor, because what he is looking for, okay, all this is good, but how will I benefit? Because my goals are a success which is a byproduct of your success. I understand that you will succeed. Please show me how I will succeed if I decide to participate in your venture as an investor. That is most important, because investor comes in looking to see his return, his outcome, and his benefit, right? Now, very often when this happens, very quickly, the discussion goes on to the valuation of the business. Let's say in a very early preliminary discussion, the investor is conceptually and directionally sort of getting convinced, all right, this looks like it can go somewhere. So what are we talking about here, in terms of where is your business scale and size, and what would be the valuation of your business today so that I can price it correctly in today's context. Now, it is a founder's job to make the capital available when needed with minimal time and effort and condition. If the founder gets hung up on the valuation as a number, because generally there is a belief, and I say it's almost a myth in the mind of a startup founder, that if he gets a higher valuation, he has won, he has benefited, and he will therefore, be able to take advantage of this in the long run. But my submission to them always is the valuation where with minimal fuss, you're able to make capital available with minimal time, effort, and conditions is your job. The absolute number is meaningless, but the motion and momentum and continuity of your business, the energy that you have built, the plans that you have in mind for them to be executed, you need capital. Don't waste time. Don't get hung up on the valuation number. Be flexible. The investor must also see an upside because you are responsible to make available capital with minimal time, effort, and conditions, right? A so-called valuation lower number may in fact set up a smoother glide path for the future fundraise events. Then the investor must also see the hidden upside, as I was telling you. I keep giving people some examples, and it's very, very easy to tell them that if somebody is trying to raise capital and the founder feels the valuation at a seed state of his venture is about $10 million, but the investor does not see any upside beyond $5 or $6 million. Now, a back of the envelope calculation will tell you that even if the founder was able to raise capital at a number closer to $10 million valuation, the future targets that he's setting for himself to get capital become tougher. And the future vision of onward rounds of creating value for investors which will enter in those rounds gets higher and harder to achieve. You may have succeeded in achieving your goals, but because your valuation marker was set high, a 5x, 6x of the valuation of your base level may make it unsustainable for incoming investor to see value, and then you will see the struggle that you had a false valuation because you probably thought a larger absolute number is bigger and better for you, and in the process you have probably lowered the probability of getting funding in the next round, which can even be very, very critical. So all that you have to do is first and foremost demonstrate to the incoming investor that you have natural inbound traction by way of either paying customers for your solutions, if it's a product service for which you can readily exchange value, it's a consumer product or a service, in which case people will normally look at, do you have paying customers? Is the traction normal? Is it inbound? You didn't have to go out of your way to market to buy sales. Or if it is a deep tech where the magic will only happen once your product is fully built out, then is there a long-term build out of your venture? Then the validation parameters change. Then perhaps it is that you need to take a ride on some very, very, respected, credible members who are domain experts, who have looked at what you're trying to build. They believe in it, and they are maybe on your advisory board. Maybe they're helping you. Maybe they've taken a small, equity position. Then that will set the confidence and will be the equivalent of the traction that you would have demonstrated in your business if you were selling a consumer product or a consumer service. For a low barrier, low friction conversation, ensure that your investment proposition delivers a mutual benefit. I touched upon that a little bit earlier. You must do sincere homework in a two-way ROI for yourself and for your business and the investor. And this is very similar when you are trying to sell a B2B product, because in a B2C product, it's difficult to gauge the individual consumer's ROI. You go by satisfaction and delight, excitement. People saw they liked it, they will buy more. You do some kind of a sample survey and you get good positive feedback on your product and brand, and that you demonstrate is a success. But when you're selling a B2B business, then you are typically selling a product or a solution to another business owner to whom your product or solution is an input, and he will use your input to enhance his value proposition in turn. And what is it that he will pay you? And what will be the enhancement that he will have incremental to his business would be the sort of rough ROI that you must make sure is viable for the customer to buy your product. In a similar setting, you must pay attention to what is the sort of ROI that the investor will feel confident and will feel is there, for you have a smooth, low friction glide path to getting past the investor's initial hesitation. This can be very important. What does it mean? In a B2B context, it means that you must have a very good understanding of your prospective customer's business and organization, his unit economics, and where your product or service fits in, right? So similarly, you have to find a way of identifying that where does your value creation fit into the ROI expectations of the investor for it to make sense for him. Yeah. The ability to accurately forecast this and many other parameters, you know, is critical for your business. When I'm saying I'm telling you how to pitch a business, it's not just about how good your presentation is. You have to take the prospective investor through the whole journey of how you will succeed. And one of the things that I have always tried to encourage all the founders that I mentor and my investee companies, and is based on my own experience professionally as a corporate executive, is that your job as a founder is to de-risk the decisions that you will take which are material to your business outcome. And for that, it means that you must have the ability to forecast what are the outcomes that you will achieve as a result of investment in people, in product, in marketing, in channel, distribution, technology, supply chain, warehousing. You are a bundle of many, many fresh experiments, tentative experiments that you're going to carry on, combine, and move forward. But the more accurate you are in your ability to forecast, the less is the risk in your business, the less you will burn your resources, the more incremental progress you will make, and you will go forward. So it's not just sales. Of course, sales is a very critical parameter. Typically the example I give to people over here is many years ago when I used to work for Frito-Lay, the American snack foods company, a very successful company. The whole organization used to be head and shoulders above all its competitors in every parameter because they had accurately understood that the one most critical thing that the consumers prefer over anything else in a salty snack, in a savory snack, is freshness. So if you have to be successful, you must deliver the most fresh product, and you must also be seen as delivering the most fresh product. And they realized that for the product to be fresh in the hands of the consumer, it must be fresh in the retail shelf, which means that the time between the factory producing the bag of chips to it hitting the retail shelf, it must be fresh, which means you can't have overstocked in the retail shop because then you will be selling sales stocks, stale stock. So therefore, a large amount of the incentive of the sales team was not on volume of what they did for their targets, was on the accuracy with which they forecast their target. Because the theory was, if you target accurately, not more, not less, then you will automatically be making sure there is no overstocking, no stock out, product is always fresh. It will naturally find the largest number of customers and we will win. So I use this as a principle to tell all the founders that de-risk your business, be good at forecasting, have data that you can, as much as you can have before you make a decision, so that you are not investing money in speculative things, whether hiring people, investing in marketing, in sales, merchandising, whatever it is that you're putting your investment in. You must therefore be very, very aware and cognizant that when you make a business decision, any startup doesn't have the luxury of the data and experience of past 20, 30 years, research, insights, brand equity, and so on and so forth. They are new, they are fresh. They're moving forward on the basis of assumptions, hypotheses, and market insights that they get. Now, as long as you as a founder demonstrate to the investor and in your life as a founder that I am aware that if I am taking a decision regarding my product, my sale, manufacturing, packaging, advertising, positioning, I'm aware that 1 to 5 is a set of assumptions on the basis of which I'm crafting some hypothesis. And there are some market insights I have on the basis of what I've done in the past. And my job as a founder is to create a culture across the organization so that you are able to convert your assumptions and hypotheses by either validating or rejecting or tweaking into market insights and evidence because that means that you are, as you move forward, mitigating the risk of your business decisions, and you will be therefore be more accurate in what outcomes you want, and therefore you will use your capital and every other resource more sharply, targeting towards the outcomes you want versus hypothetically based on just assumptions. And you must therefore be aware and build a culture that you demonstrate the agility to constantly organize your organization and your team to develop what is your proprietary internal equity book. Let me explain. This is a proprietary term actually that I use a lot in my presentations and in my mentoring sessions with the founders and everybody else. Every business writes its own book of success. Every business understands what works, what doesn't work. As businesses become mature, this proprietary book becomes really the asset, the key asset, the competitive advantage that it can use versus somebody else who doesn't have those kind of equity insights, market knowledge, and consumer behavior, whatever it is that you need, right? You know that when you are starting up in an early stage, that the stack of your business book has got bigger chunk of assumptions which are speculative. The outcomes will not be what you will always wish to achieve or target to achieve, and it'll be a very small base of equity that you know, which is evidence and insights which you can't go wrong. You must know that it is your job to recognize what are the assumptions, what are real insights, and on the basis of outcomes that you get by doing analysis, increase the size of those insights which build the strength of your proprietary internal equity book, which is your core IP, which is your asset, which is your advantage, which keeps you ahead of competition. So when Frito-Lay identified that, a lot of things matter: marketing, advertising, targeting at the youth, packaging, flavors, range, pack sizes, but they knew that the overriding advantage comes from you being able to supply something which is fresh, more fresh than the others, and everything else should be crafted in service of delivering the most fresh product on the shelf, and they would win. And that kept them ahead of competition by 10 to 15 percentage points of market share forever. Every business must have this proprietary internal book with a mix of business premises. A General Electric, a Siemens, a Volkswagen, they will all have their book. But these are large, mature businesses. They will have a very heavy set of ideas of what they think they should do will work. And a startup will be nimble because it'll have a lot of assumptions and speculative premises. It can be an advantage, it can be a disadvantage. If a large company is not also constantly being nimble like a startup and continuing to struggle to add newer assumptions, to reach out to newer customers, newer markets, innovations, they will stagnate. But if a startup does not build its book of equity, it will expend its capital without making any progress. So therefore, there is a dynamic balance that you must always have, whether you're a large, mature enterprise with decades of experience, or whether you are a fresh startup, which has got only very few years of experience. But the principle of taking a business forward is that you must constantly be adding newer assumptions, newer hypotheses in search of new markets, products, customers, and growth. Otherwise, you will stagnate. As I said, in a startup, the proprietary internal equity book, the quantum of assumptions which are unvalidated are predominant. While in a large, mature business, the market-tested, evidence-based premises dominate, right? The startups are envious of large companies having a very mature understanding of the market, but the large companies are envious of the agility and the nimbleness with which sometimes startups can experiment, they can innovate, they can pilot and move forward and pivot and disrupt them. So therefore, one has to be aware how to keep the right balance in growing forever. Now, one of the this goes to the heart of what I tell a lot of entrepreneurs. Entrepreneurs are constantly self-belief, and the culture and the core message that echoes around is entrepreneurs are risk takers. They take risks. In fact, I tell the entrepreneurs, actually, no. You don't take risks. It is your job to manage and mitigate risk. Your job is to de-risk your business actions. Why? Because you have limited resources, limited time, limited energy. You can't take a risk. You've taken the biggest risk by maybe chucking up a big, good job that you had and turn an entrepreneur. You have taken a big risk. Now, from here on, the world may think that you've taken a risk, which you have, but inside your startup, you don't take risks. You identify risk, you manage risk, you mitigate risk because you look at a lot of data, you do a lot of analysis, you take a lot of calculated bets, and you have a very hands-on culture of measuring because the line of sight between what you wanted to achieve and what you end up achieving is small because it's not a complex organization with 30 locations, 40 products, 60 markets, right? That you're forced to look at data to see what's happening. You are a startup, you're hands-on. The line of sight between what you had attempted to achieve and what you actually achieved can be very easily measured, except you must be open to knowing that that is important and spending time and energy in creating that beta, that delta, so that you know, oh, this is what went wrong in my targeting, in my demographic, in my market reach, in the channel I chose, and quickly pivot and change. So therefore, you are de-risking. You are managing a mitigated risk, not taking an open risk. This is a very important point. And the entrepreneur who understands this quickly understands that, what the game is versus getting carried away by slogans that are popular in the market outside. So, so if that be the case, then one of the key things that I would look for in a founder as an investor, and therefore an attribute I must have as a founder, is I must demonstrate to them that, I am aware that when I am taking a business decision, these are the assumptions or hypotheses that I'm going to test and validate with the investment I'm going to make and with the outcomes that I get from the actions I've done. I will draw some insights. And based on the insight, I will quickly go back and rearrange my proprietary internal equity book. Either my hypothesis will be validated or not validated. The assumption would come true or not come true, but I know that I have to go back based on the outcome and do this organically all the time on an ongoing basis. So when people say, oh, founders must be nimble, must be agile, well, this is what it is. When you break it down into what does that actually specifically mean in the context of business actions that you must do, this is what it is. That I must be aware where I don't have data, but I'm still taking a decision, where I have a feeling I don't have insufficient data or understanding when I'm doing it. And I will, on the basis of the actions I have taken, enlarge the quality of my data and insights and strengthen my book. And then for growth, bring in newer assumptions for further growth and further activity in my business. So when you develop this way, you will create your internal proprietary equity book internally and incrementally into a powerful external competitive advantage, unknown or unseen to the world, including your competitors. This would become your most prized asset of the venture. This would become the most defining competitive edge that you will have versus your competitors, that you are busy shaping, crafting, building organically your internal equity book on all aspects of the business. I'm not only talking in context of sales, I'm talking in context of the kind of people you must hire, the kind of business partners must you have, the distributors must you have, the kind of technology that you must have. All these things in the beginning, you take bets, you take small bets, but you incrementally measure the gains or the lack of and improve your book. And you will organically do this. You will realize that if that is the culture you set in, if that's the way you run your business and that's the way you cascade the culture with your organization and all your functional heads are driving the same work culture wherever they are, you build a very powerful book very, very quickly which will be giving you the biggest competitive advantage. And when a startup, you don't take big leaps on anything, right? Now, I know sometimes founders think, sometimes investors encourage that, you have to show, breakout growth. You must do something which has not been done before. Take large bets. Now, I can understand an investor encouraging a founder to do this. Why? Because investor is taking 10 bets, 20 bets, and he will encourage all of them to think big, leap big, go forward. Because he is happy if 2 or 3 of those leaps pay off and the rest don't, he will kind of then pursue those and make his portfolio a success. But you as a founder must know that this is one place where there is sometimes a disconnect because you can't take a big leap. You have to take measured, calibrated steps forward so that you are tracking and tweaking and moving steadily in your core business. So this is something which the founder must be aware that if the investor is exhorting you to do something very, very challenging and throwing money and promoting the idea of quick growth, it may not be in your best interest to just blindly do it. Of course, unless you have a clear visibility and runway of that you can grow big and you must do it, but you must give it a great deal of thought whether you're doing it simply because the investor feels you should do it and maybe your own current business opportunity doesn't permit or doesn't allow this. So while you're doing this, constantly evaluate performance and outcome versus that which was predicated by underlying assumptions. But if I take this channel, my cost of distribution may be 3% lower than if I take a channel partner. Now, when you actually go and test both the channels, you might either find it happened the way you had planned, or you may have found that it actually happened the other way around, in which case you will then have to go back and re-engineer your entire channel distribution and other strategy. But you must be aware, you must track, and you must quickly pivot and make those changes. Otherwise, you will realize it too late, and it will, with the limited resources that you have, you may not get a second chance of doing things. Always keep 20% of your resource, energy, and mind space for innovation. You are a startup, you're an innovation lab, you're a pilot by yourself, right? But even within that, you must make sure as a founder, as a leader, that you will encourage your team that please, whatever we do, 20% we must keep for innovation, because to drive the culture of thinking new, of challenging yourself into looking at possibilities beyond what you are currently targeting. Because this is where you can leap ahead. So if somebody is trying to tell you leap ahead, move ahead, to say, okay, I hear you, but I think the best way to do it is maybe set aside 20% of my resource and my bandwidth to do this leap ahead, move ahead, do experiments, the fringe energy of the organization, but the 80% core of the business, I will chase on the basis of what I think I want to see: organic traction and growth. And this organic traction growth done rightly will by itself become exponential over time. And whenever you've got the right understanding, alignment with the customers, client, and consumers. While evaluating an investor, look for the right business partner. This is again something which is highly, highly, highly underestimated. Very often, a founder will just step out because he thinks he needs money to grow. He will go and start looking for the money. But 3 or 4 things are very important, for you to judge how much money do you need, who is the right partner. The right partner is the right business partner who will bring to you not just the value of the check, but will bring a whole stack of incoming resources: mentoring, strategic advice, alignment, onward funding, throwing open their own network of prospective clients, customers, new markets, and so on and so forth. That's the right business partner who will now, after having made the investment in your venture, is now saying, now it is my job as much as it is yours to see that you succeed, and I will make available to you everything that I have. So therefore, when you are looking for an investment partner, please make sure that the incoming investor has the potential has the capacity to bring those resources that you would need to grow beyond the checks. How much money do you need? Well, rough rule of thumb is that you must demonstrate to the incoming investor what will it take for you to reach the next inflection point in your journey to grow. And the inflection point can be sort of roughly defined to mean that I will have transformed my business from where I am to another place from where the next set of growth opportunities are looking as real and as exciting as current opportunities are from where I'm sitting today. Goes back to what I said in the beginning. You must tangibilize the future success in the context of today. So you must be very clear, what is your next inflection point? Is it that you will reach 10,000 customers? Is it that you will launch in 2 different markets? Is it what that you will launch at least 3 different products? Is it what that you will prove your proof of concept in 2 different demographics? Whatever it is, that inflection point must be clear so that the investment journey from here to that inflection point is relatively well defined. Then you can right size your investment. Therefore, to go from today to inflection point B, you need X amount of money for marketing, people, hiring, technology. You know exactly how much money you need. Put a buffer, and that's what you need. And when you reach the next inflection point, then the same story that from inflection point B, how real, how credible is inflection point C, and what are the milestones you need to achieve, what's the resources that you want to have, and what kind of business partnership that you might need. At that point, you might need a larger business partner who can give you access to international markets, which the initial current legacy investor might not have been able to give you. You maybe need connects of a different level altogether. Maybe you want to do government business. Maybe you want to target transnational corporations as your clients. So therefore, you need to evaluate afresh the stack of incoming resources that this investor is bringing in. As I said earlier on, do not just get hung up to maximize your valuation. In fact, a false high valuation would leave you stranded despite your good performance, because a good performance will not relatively look as good a performance had your valuation number been more attractive, lower, or optimal. That's again very important, and founders need to be guided and mentored very early on. It's very hard to convince them this. It's not easy, but the ones who understand usually get to see the success in the future rounds of the investment. Define the inflection point in your venture that it takes to the next transformational phase on a precise performance milestone. I touched upon that just 2 slides ago. So therefore, once you're very clear as to what is the next transformational phase of your business, what is it that you need to achieve to invest to that milestone or set of milestones and goals, that is exactly the quantum of your fundraise. So the right business partner, the right next inflection point and transformational phase, it gives you the right size of the investment. So you're kind of ready now to go out and look and find the right business partner with the right quantum of investment. Investor, remember, will only cut a check when he or she has a confident and a credible visibility that you will have future paying customers at a scale that you don't. That is what I mean by tangibilizing. You got to make the incoming investor feel confident that, you know, there are future paying customers on their way, and I need you to underwrite my journey between now, when they are not there, and between then, where they will be. So the more evidence, the more data, the more confidence that you can inspire about future paying customers, the more you will tangibilize your story for the incoming investors. The ability to attract the right talent at a lower than market price is also a key requirement, and demonstrates that you can make an effective B2B pitch and that you can make a successful business. You need, you know, tier 1 talent today, but you can't afford to pay them market prices. So your ability, the first pitch, even before the investors, has got to be to the kind of leadership talent that you must bring into your organization today at below market price so that they are aligned to the future upside of your business. And when you show up to an investor with a very talented team who have the experience, knowledge, energy, and passion, then that in itself, because a lot of investors will tell you, oh, they will invest in the quality of the founding team. Some will want to invest in the quality of the idea, the largeness of the idea, some on the traction, some on unit economics. So therefore, it is very critical. I mean, investor look for all, but they may put more weight to one over the other. But having a strong team at the beginning will help, absolutely help. Integrity, transparency, ethics, making is key to your business. Okay, no surprises, nimble, humble, making mistakes, accepting mistakes, learning compassion and core value, and the founder might be set up, they establish the venture. If there is a doubt in the mind of an investor regarding your integrity, your ethics, the transparency with which you conduct yourself, you will not get anything. And put the hat on as an investor, you wouldn't cut a check to a person who, no matter how bright, no matter how promising, no matter how energetic. But if you feel there's a question mark on the integrity, you will not move ahead. This is very important to tell them, because it is quite likely that in the early stage, some of the founders have taken some shortcuts. They have maybe compromised on compliances, or maybe they have done a few things which don't speak highly of their ability to run a large business with the right ethics. I would never invest in them. I would absolutely never invest in them. You must at all times function and learn, build, and operate a very lean organization. Startups, by definition, are lean. In a startup, there can only be two sets of people, two sets of employees. One, those who bring customers. Two, those who serve the customers. There's no place for a third person on the bench. Everybody has to be forward-looking. My job is to bring customers. My job is to serve customers. That's it. And everything at the back end, you have got to find a way of doing it either by yourself or third-party partners. You don't invest in bench strength in people sitting behind you, right? It's very critical. And when you scale up, you are still going to remain very lean as your venture scales up. It's just that you will maybe add one more layer. As I said, those who bring in customers, those who support those who bring in customers, and another set of people, those who serve the customers and those who support the customers. That's it, no one else. So once you understand that this is what you need by way of functionality through the human talent in your organization, you will be very, very sharp. You will be growth oriented. You will have passionate people working hard, multitasking, moving forward, and not having people who are sitting as passengers in your business that you don't need. As a founder, you must set up a performance-driven and a thinking and learning organization from day one. One of the things that I always tell all, not just leaders, but even managers who have, teams working under them, that you must set up a culture that if somebody in your team is facing a problem, they must have the confidence that they can escalate the problem to you. Not a problem. Open door. They are stuck. They want to move ahead. They want to come to you. They come to you. But let them not come and just throw the problem at the desk hoping that you will provide the solution. They must have a corresponding recommendation of what is their idea of solution. They may be way off from what the actual solution may be, but encourage them to think. Don't think problem, think solution. Your problem, what would you recommend we do? And that is maybe initially they may struggle to find a right solution, but if that is the culture that you will build, they will slowly get very good at thinking solution solving themselves, so that the leadership team is not bogged down in solving internal problems. They are looking at the customers, clients outside in the world in solving those problems and not those inside the organization to the extent possible. You, your team, your investor have one common boss, and that's your customer. Ensure you're all aligned in your mission to serve them better and first compared to the existing alternatives. If that is the culture that you will cascade, that we are all working for our customer, and hence everybody has to either be bringing a customer or servicing a customer or servicing a person who's bringing a customer or serving a customer and no one else. And if you have a problem, think a solution, and try to self-service, you will never have any problem. This is a slide which I think only my Indian audience will understand. It's a bit of a plug line for IAN. Translated in simple language, it means that if you're a founder and if you have not pitched to IAN, you haven't begun your journey. Thank you very much, folks. That was my presentation, and I am happy and available to answer any questions. Yeah.
Yeah, thank you so much, because I think, I mean, firstly, the time is impeccable. I think you just halted it on dot. Very German, I must say.
Amrita, you are the boss, and I work for the boss. You gave me a 45-minute deadline. I am working for you on this.
Thank you so much. And I think that was a very, I think it was a very fluid presentation. And what I personally like, I was not really expecting a presentation like this. I was expecting very intense graphs and sheets and so on, very investor-like. But I think this is a very lucid presentation in the format of quotes, very interactive as well. I wish we could have had the audience as well ask questions to you directly, but unfortunately, due to technical restraints, I have to act as a moderator here and bring to you what the audience has been saying. So, of course, yes, there have been a few questions that have come up as you were speaking as well, and they are quite a mixed bunch, I would say.
Okay.
And I have put it already on the
chat box,
chat, but I will read it out for the sake of the entire group as well.
Okay.
Yeah, so the first question that we could take perhaps is being cash rich important in spite of having debts as a startup?
Well, I mean, a startup should not have debts because startup by definition is resource constrained. And whatever limited resources that you have should be going to build the brand, the product, the technology, and not servicing debt. In fact, if in an early stage, if an investor comes across a startup which has debt, they will get a little deterred by saying, hang on, because my money will go to service debt. I want every single, cent or euro that I put into your business to go and work for the business.
Great, thank you. And there was another counterpart who was asking specifically about Indian Angel Network. What are the key sectors that you're working? What
focus?
Say?
All right. So Indian Angel Network is a full stack early stage investment house. We have more than 500 members globally, worldwide, in all the principal business jurisdictions of the world. We have domain experts in practically every jurisdiction where today's startups are coming up. So I would say there is not a single sector that is not addressed through either our members, our domain experts, or companies in our portfolio over the last 10 years. I mean, Padmaja must have told you, we probably have, I think, in excess of 300 startups in our portfolio till date, right? And these are in every sector: edtech, agtech, biotech, consumer, deep tech, fintech, edtech, everything, e-commerce, retail, media, travel. So I don't think anyone should worry about not being able to find, at least in IAN, the right set of business partners that I was talking about in the presentation, who can be from their sector.
Great, thank you. And I think the next question is a little bit of a follow-up to the previous question. I may say, has your strategy in investing changed post the pandemic? If yes, how are you looking at?
Okay, so very interesting question. Yes, and I would say it's a bit of an S curve. Okay. Before there was a pandemic, we used to meet physically once a month,
Okay.
in a hall. Of course, the Zoom option was available, but there were 40 people in the hall and 5 on the Zoom. Okay. And the founders would be there in person and we would take their questions. And we felt that was the way to do it. People are sitting, asking questions, looking at each other. And it was very enriching to sit and watch each other ask questions and ask the founder, right? Now, when pandemic happened, it suddenly moved to Zoom, right? And people wondered because one of the things that people talk about angel investing is you should have line of sight. You should know and feel the founders. You should see their passion. In Zoom, that was missing. But as people internalized Zoom and became comfortable with Zoom, it was like as good as being back in the room physically as well. In fact, better because now we are having pitches every week. Because previously, what used to happen is Bangalore, Bombay, Chennai, Delhi once a month, every month. So we would meet once a month physically. But now every pitch is on Zoom. So therefore, every week, everybody comes. So when we used to have physical presence, 40, 50 people in the room. Now we have sometimes 100 people, on the presentation. So the comfort level has come because now Zoom is a mainstream business utility. Therefore, it is now not seen as an impediment, when you are looking to evaluate angel investment. I mean, I have made 5 or 6 investments, in the pandemic phase where I've not met the investor at all.
Great.
I would say, previously, I would say, line of sight, I must meet, I must sit, I must have coffee, I must meet your team, must come to your office. And I would do that, right? But now I haven't seen them. And I don't
And you are comfortable with that?
Yeah. Absolutely. Absolutely. So, which is
The
why
presentation speaks.
which is why if you are now evaluating deals from Germany or invest from Germany into India, I think everybody now gets it.
Great. I mean, that's the next question, I think. Would you be open to investing in German startups setting up in India, and what are the requirements for them? I think in a way that one point, if I may add here, the comfort level that you have mentioned with investing in startups offline or in a remote working is really an added advantage for startups that are really looking for internationalizing. But at the same time, from a German perspective, maybe if you would like, I think that's one of the German startups listening in who asked.
No, sure. So, I have 2 things to say here. Right? I think initially, you will probably get more momentum of German investors investing in India.
Yes, that's the trend. Yeah.
Yeah. And once there is a sense of comfort about German investors realizing what it takes to succeed in India, what do the investors think and the founders think, then they will be able to curate the right startups where Indian investors will be comfortable investing in Germany, right? See, because when you are investing in startups in India, you know the market, the context, you know the market size, the competition, blah blah blah. So there's a sense of comfort. So in German, if one was to invest in Germany, then you would have to develop that intelligence that requires for you to put things in the context of the German market, German competition, German regulators, German, market opportunity. So that may take a while to happen, but initially, if it is inbound, then it'll set the path for outbound.
Great. And one of our, thank you so much for that. I think I hope the startup has listened to that point. And one point, which is a running mandate for GINSEP, the focus is definitely on internationalizing between Germany and India. So with that in perspective, the final question, do you or other investors in your community find early stage startups who are going global exciting? I mean, do you think these 2 things go hand in hand?
So early stage startups who are trying to go global, no matter where they are from, people will not take them seriously unless they have demonstrated success to a critical level of performance where they feel, yes, you can cross border and compete. So okay, some businesses may start maybe in tech, maybe in SaaS, that they feel that they can from day one, they have to build a product which must be good enough for the global market. but actually, initially they have to demonstrate success in the home market, and then people say,
Exactly.
okay, this can easily travel to other markets, and we can take it there.
Yeah, also I think the sheer size from an Indian perspective versus Germany is different, because in Germany
Sure.
sometimes there's a trend that they are born global, at least within the European market, and
Sure, sure,
then
sure, sure. Absolutely.
coming here. But completely, thank you for that insight.
Wonderful. So we're back here in the studio live from Berlin. So thanks a lot, Vikash, for a great workshop. Me and Julian were in the other session, but I'm quite sure people were following you closely, and I saw there were a lot of participants. So thanks a lot for dedicating your time and to
Thank you.
really bring people up to speed and to share from your rich experience when it comes to startups doing their first steps, getting acquainted with VCs, pitching, and being on point.
Not a problem. Welcome. My pleasure.
Wonderful.
Altogether.